Coming up on Market to Market, weather presses crops as extremes of heat and precip grip the nation. Plus, a look at who's buying land and its value in the grain belt. And market analysis with Naomi Blohm next.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next. Because a pioneer, our name is our mission.
Precip Manufacturing, celebrating 60 years of innovation as a family-owned and operated manufacturer of grain storage, drying, and handling equipment out of Sheffield, Iowa. Learn more at precip.com.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, August 4th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. What has almost become a message on repeat. More jobs were created in July, and the unemployment rate stayed historically low, even with the Fed still raising the prime lending rate. U.S. employers added 187,000 jobs last month, about the same pace as June's report. Previous months were revised downward, indicating the weakest additions in 2.5 years. The unemployment rate dipped to 3.5%, still close to the lowest mark in half a century. As more people entered the workforce, this kept a lid on companies raising wages to retain staff. The Mid-America Business Conditions Index declined on the month and below the growth-neutral threshold. The reading of 46.1 is the smallest since the pandemic began and leaves open the door that a recession this year is still, quote, on the table. The stifling heat dome over Phoenix, Arizona finally broke this week, ending a streak of 31 days of 110-degree heat. However, the cool down is expected to be short-lived. The high temps from the west to Florida have impacted most outdoor activities and work sites, including a drop in productivity for Amazon deliveries, utility workers, and refineries. David Miller has our extreme weather wrap for the week.
The U.S. continues to be gripped by above normal temperatures and pounded by precipitation that comes in torrents. A brief but heavy downpour early in the week helped firefighters battling a massive blaze in California and Nevada. Meteorologists warned of the potential for sudden and erratic wind shifts that could endanger crews in the near future. Experts say the places where streets and buildings are plentiful create urban heat islands. This week, those living in the Bronx found themselves continuing to look for ways to beat the heat and stay cool. Warmer than normal temperatures dominated the Midwest this week as temps hit 8 degrees above normal. Portions of Wisconsin, Michigan, and eastern Minnesota recorded rain amounts that were up to 300% above normal. Corn in the good to excellent category combined for an increase of 4 points. Soybeans in the 18 states responsible for the majority of the crop saw a 6-point increase in the same column. Areas of the Pacific Northwest recorded temperatures 6 degrees below normal with monsoon rains, while Montana had an expansion of the drought hitting the area. Drought continues to have a hold on the nation's midsection. In the Midwest, some abnormally dry areas improved due to recent rains, while areas of serious drought expanded just a little. For Market to Market, I'm David Miller.
Double-digit growth in land values have been a boon to sellers, but harder to handle for some buyers. As grain belt prices increase, the question becomes, how much longer can a rally last, and who is behind these sales? Politicians are floating limits on foreign ownership, but as Paul Shadig of Farmers National Company says, the age of the buyer is the bigger story, as the industry also looks to balance growth and be acceptable to more people involved in working the land. Here are a few excerpts from the next edition of the MTOM podcast that makes up this week's cover story.
What we've seen, it's if I look over longer term, and that's kind of how I analyze things in that 5-10 year time frame, we've seen some really nice gains in land value, especially over the last 5. But even if we stretch that out to 10, they weren't quite as quick in the early part of that 10-year time span. And then the past 3 years have been just astronomical with what land values have done. Now, what we have seen is we saw things kind of slow down a little bit in the fourth quarter of last year. And then as we came into 2023, it was kind of, let's see how this is going to pan out. And we've seen a further, what I call a de-escalation of values. And not reading too much into that, we're not talking about a drop in value. We're just not seeing increases as strong as we did, in 2021 and 2020 and 21 were just through the roof, and double-digit increases across many states. And now we're just down to where we're seeing maybe some single-digit increases. We've even seen some slight decreases when we talk about lower classes of land. Higher classes of land, still great demand for that, and they're still paying a premium.
Which is better for the industry? Double-digit increases or a little slower, 1 to 2 to 5%?
I'm a believer in slow and steady, and if we look out over that time period of go clear back into the 40s and see how land has appreciated over time, I really like that slow incremental growth. And so those sharp increases are a little bit spooky because they tend to breed sharp decreases. But the way the ag economy is today, we don't foresee that happening. It's in strong hands. It's not highly leveraged. The ag economy in general is pretty healthy. But that always is a little spooky to see something go up, because I'm a believer in the pendulum theory where, as hard as it swings one way, it could swing the other.
Well, let's go back to your beginnings, the 80s. You saw how quickly things can move and change. Are we in a state of the 80s again here right now?
And based on the way land is not highly leveraged and that balance sheets look good, we're certainly not there. Now, there are a lot of environmental and geopolitical events that could happen, that could drive us to that point. But in today's market, no, we're like I said, the land is held in very strong hands, unlike the way it was in the 80s, 70s, and 80s. So yeah, we feel pretty good about and very bullish about agriculture in general.
Who is buying the land? Do you keep track of that?
Yeah, we keep close tabs on that, and it's an interesting dynamic. We see, you read the stories about, celebrity buyers and foreign buyers and things like that, but that's what hits the news. The real story lies in that there are the land is being purchased. The actual buyer of the land, over 70% of the time, is a operator farmer, local usually, and they're adding to their farm operation. Now, in saying that, there's a reason that these land values have moved up, and there's another class in the investor type buyers, funds, and just individual investors that are very interested in buying land. And so they are definitely holding a floor, and they're pushing some of those values up. But when they reach a certain point for their return on investment, they step away, no emotion, and then that's when the operator will make that final bid and usually ends up with the ground. And there's a lot of motivating factors. There's guys that have never seen a farm next to them come up for sale, and so they want to take advantage of that. And there's some pressures with making your operation a scale that will work in today's economy. And so that's the motivation on their side.
Is there an age of a producer? Because what I hear you saying sounds like an old producer, 70 plus ownership. Is that accurate?
As far as buyers go, we do see a lot of buyers in that, definitely 50 to 70 range. There's definitely a lot of that. We do see a lot of young buyers that are using vehicles, loan vehicles that are out there and options to purchase as if they're able. But I would say the majority are in that 50 to 70 range.
The Federal Reserve says they'd like to see inflation on a 2% clip. That's their goal. Is that a good land value increase goal that you would like, a 2% gain each year?
When I look out across that long-term chart, I feel good about a smaller gain than what we've seen the last few years. That's where I say, you know, those sharp gains are a little bit spooky because you're worried what's on the other side. If I'm speaking for other landowners, 2% might be a little bit low. They would probably rather see something closer to 5. If I look at it from a landowner perspective, I would say that I would rather be a little higher. But I also understand we have some struggles going on with the economy in general, and we've got to figure out how to get a handle on that.
The full discussion will be part of the MTOM release on Tuesday.
Next, the market-to-market report.
Drone strikes in the Black Sea, along with forecasted rains, were the headline market movers for the week. The nearby wheat contract plummeted 71 cents, or 10%, while September corn dropped by 37 cents. Soy meal did its part to support the soybean complex, but not enough to keep off big losses. The September contract closed down 46 cents, and September meal lost $11 per ton. December cotton expanded 3 cents per hundredweight. Over in the dairy parlor, September Class 3 milk futures shed 21 cents. The livestock market was mixed as October cattle added $3.30. September feeders gained $4.47, and the October lean hog contract cut $1.95. In the currency markets, U.S. dollar index rose 44 ticks. September crude oil improved $2.24 per barrel. COMEX gold lost $21.40 per ounce. And the Goldman Sachs commodity index moved sideways to settle at $593.35. Joining us now is market analyst Naomi Blohm. Hello.
Hey, Paul.
You're in all black. Is that by design? Is that a statement on the week?
Well, maybe so. I mean, we just didn't have, for the grain markets, enough news to keep prices just at those higher values. And the outlook kind of for the next couple weeks, especially with this better weather moving in, there's not a lot of friendly news to talk about in the short term.
Wheat had a lot of headlines in the Black Sea. Drone strikes, port closures. Then we see, yeah, we're going to get this done, but we're going to go this way instead. Is that still the biggest mover on this complex?
For right now, it is. All of the situations happening with the Black Sea are going to be front and foremost to the market right now. What was interesting is that we had 2 big headlines in the Black Sea with various war efforts that were happening there, and that was enough to get the market to trade higher both times on the overnight trade. But then throughout the day, the market started to ignore it. Part of the reason that the markets are ignoring it is because the rest of the world is really trying to send a message to Putin that, you know, heck or high water, we're going to make sure that this grain is moved out of Ukraine. So we've seen Croatia step up. We've seen other countries saying that they're going to do their part to help make sure that that grain is moved. As far as any bullish news, the only little bit that came out this week actually was from India. India said that they're going to likely be stopping an import tax because they are in a situation where they're usually self-sufficient in wheat, but they might be needing to import. Now, it was interesting for them to also say they might be importing wheat from Russia. So a lot of moving parts out there, but wheat just can't get some friendly news right now just to make the market rally.
India has proven that they will buy from anybody.
Yes.
And that, so how does the market respond to that news then?
Well, it's mixed news, right? So in a sense, the market is frustrated because Putin still has a customer. But at the same sense, the fact that India is going to be needing to import wheat is actually bullish because that means that their global supply, their supply is lower. And so that would be supportive to the marketplace in general from that capacity. But again, with the wheat market right now, the funds are still relentless sellers. And we are sitting on price support levels for the Chicago wheat, Kansas wheat, Minneapolis wheat. If we can't get some friendly news out of the USDA next week, prices just might continue to slide a little lower.
Did you just have a hotkey on your keyboard this week in all your writings for the word support? Because corn was in the same boat.
Yes.
You were dancing, soybeans, dancing on support level. Corn and beans had a pull affected wheat. But what's corn's story that stands out to you?
Right now with the corn market, we're sitting on $5 support. Below there is $4.90 support, and corn is not getting a lot of fresh news from the standpoint of not any big export news coming for corn market right now. And we have the Midwest really going to be seeing some good rain potential over the weekend. And then we have cooler temperatures coming for 2 weeks. Fargo, Des Moines, Springfield, all of those states, all of those cities going to be seeing the ability for low 80-degree temperatures, and that's great for filling those kernels. So I'm a little concerned with the corn market. With the USDA report next week, the USDA is going to be probably slow to drag their feet on any big further yield reductions. They don't have boots in the ground measuring yield for this report, so they're doing farmer survey, they're doing a little bit of satellite imagery, and then the statistical surveys that they traditionally do also. But if the USDA, let's say that they bring yield down even just to 175, which is lower from 177.5, we still have a 2 billion bushel carryout. And without any big traction on exports, I'm just a little concerned that prices are going to continue to slide lower. And also, seasonally, it's actually normal for the corn prices to slide lower throughout the month of August until that last week of August when we see an early harvest low come in. And the crop tour doesn't start until the third week of August either. So we're running out of news.
A friend of ours, Matt Bennett, was telling me he might have early harvest around him. So that late August crop tour they might be competing with combines. Are you hearing the same thing?
Actually, Matt was the first one to let me know that information, that it could be happening. So it would be interesting to see what the Pro Farmer Tour finds from that. And but more importantly, what the USDA says next week, because that's what the trade will follow.
Well, and I think StoneX 177 was their drop, so that's not down too much. But if you drop 2 more bushels, like you said, to 175, that changes the math. What does it do in soybeans then? StoneX there has said the yield down to 50.5. Good growing weather, good rain, 80 degrees. But if you look at the drought map, there's still a lot of drought out there.
Yeah, there still is a lot of drought out there. And the trade, though, I think is going to be focused on the rain that's coming this weekend and the low temperatures for the next 2 weeks, because that is exactly what the soybean plant is going to want. And so while we've had some uptick in export demand, all it's doing is keeping us on track for where we're supposed to be. And so with the November contract, we've got support at $13.25, support there, below there is at $13 even. But if we can't get a friendly headline next week, I think you're going to see a technical washout down to $12.50, and that has me quite concerned. That's not any place where we haven't already been earlier in the summer. And so the USDA report on Friday next week is going to be very important. What will the USDA do? Some in the industry were saying, well, wouldn't surprise me if they raised yield at this point either, especially with the rains that are coming and the cooler temperatures. So just be ready for anything really with this marketplace.
I know you had a lot of windshield time to get here, but if you believe the social media traffic, there's tip back, there's heavy 2 to 3 inches of. At what point does that factor in? Because we did have a question. I guess I better technically ask Paul's question that came in via one of the social networks. He says, how much influence will August rain have on new crop prices?
Well, I think it will. I don't think the market's going to just totally fall apart lower, but it's going to have a hard time rallying because the trader mentality will be, oh, well, that rain and the cooler temperature is going to help with kernel fill. And for the soybeans, of course, help with soybean production in general. So what the market needs to rally, 3 things have to happen for this market to rally. You have to have something really catastrophic happen in the Black Sea region. You have to have the USDA give us a bullish report next week, and then we would need to see our export demand pick up substantially for corn and soybeans both. So if those 3 things can happen, we would have a reason for the market to rally. However, I'm a little doubtful on the last 2 of those, and I'm very mindful that seasonally, those corn and bean prices have a tendency to slide lower until late August.
Do we still have any exports? I mean, the news of exports has been hard to find lately.
Well, it is hard to find, and so of course every week there's something happening. People are taking advantage of these lower prices in general, but I'm thinking if I'm an end user from somewhere else around the world, I'm not seeing the American farmer really get frustrated or upset that it's going to be nothing for a crop. I'm not hearing that headline. So they're already thinking ahead to next winter and saying, okay, well, if the American farmer has a decent crop here, and if Brazil and Argentina have a decent crop next winter, there's not a sense of urgency to just go ahead and book huge amounts. They're waiting for a harvest though. Give it 3 weeks. If this market price works a little lower, then I think you're going to see the exports really step up. But right now there's not just that news to make it happen.
You mentioned the news, you mentioned certain talking points get baked into traders. The one was, we're going to have this rain arrive in late July and early August. Maybe hasn't quite happened to the widespread. If a trader sees a difference between 177 to 175, or they see 50.5 down to 48, do they know enough to say that's not good to change things? Is that enough of a headline market mover?
On a USDA report, it would have to be a yield number a lot lower than expectations. All of it is already baked into the market.
Okay.
It's priced in. And also we have to see if the USDA changes anything to demand and ultimately ending stocks.
Let's go to dairy.
Yep.
On the week, we were, let's see, I think we were higher, or no, we were lower by 21 cents, back over 17. Mm-hmm. Does this stay this way for a while?
Well, the dairy complex, we had Class 3 milk futures have a nice rally higher. It had been so oversold and so cheap. And finally, we saw higher cheese prices and stronger cheese demand, and that lit a fire under the Class 3 milk futures price. We were able to get it back over 18, but we don't have any news to keep it running. So prices have set back a little bit lower. For the milk production numbers, now we're at a point where we have production flatlined, and we actually have less dairy cows than a year ago at this time. So we're starting to see a marketplace that has responded with a little bit less production, but we still don't have a very bullish headline there. Our exports are down from a year ago, and domestic demand right now it's okay. We're going to start to see the demand pick up as we start to get ready for the holiday season, so that's encouraging, but it's all about the cheese right now.
What's it all about in live cattle?
Well, that marketplace, it's kind of the same story, different week. You know, we still have tight supplies. What I noticed with the October contract for live cattle, the December contract, and the February contract, they are all still respecting the bearish key reversal that the market had from a couple weeks ago after that cattle on feed report where we had higher placements coming forward. So that's been keeping a little bit of pressure on those nearby contracts. We also have seen a pullback in the cutout values, and so that's been kind of weighing on things, but the deferred contracts are still a friendly story, of course, because of lower supply. And with the feeder cattle, what I really noticed on that inventory report is that the feeder cattle that are off feedlots are down 1.3 million head from a year ago. I mean, that's not anything that gets replaced anytime soon. And so, of course, that's why the feeder cattle market has a lot of support nearby, and the deferreds as well. But as far as front month live cattle go, we're still just keeping it an ebb and flow between what's the demand doing, what's the export demand doing, and what's cash prices doing.
Okay, so then that makes sense on live cattle, but then on the feeder side, is the bigger story, so in a week or a time when support's being tested on grains, that no longer is the headline. You're still seeing the lack of animals as the big driver moving forward?
It is 100% the biggest driver going forward.
What about in hogs?
So a tale of a couple different things, right? So we have the August contract, which has just been racing higher, you know, up to over 100. And so that has been substantial. But with the October contract, the December contract, they also had a little bit of a rally, but of course not as much. So we're seeing normal for this time of year for the hog prices to have an increase. We are seeing some good demand. The cutout value was the most it had been in 11 months earlier this week, and then saw a little bit pullback as the week ended. But going forward with the October contract, right now it is trading at a discount to cash, which is normal, but normally the discount is around $13, and right now it's about $20. So it's supportive going forward, and the producers are doing a great job of keeping current. So I would say with the hogs for the October and December contract, probably start to see it just trade sideways as we start to head into fall.
And we are going to head to the end. Naomi, thank you so much.
Thank you.
Appreciate it. We're going to pause this analysis, continue our discussion about these markets in our Market Plus segment. You can find both analysis, which we just finished up, and plus on our website of markettomarket.org. All of these resources, by the way, are free. We've been watching corn harvest in Texas and hay cuttings in the Midwest this week on our Instagram. We love sharing your images on our stories section. Follow our feed at Market to Market Show. Next week, we look at how one producer is finding additional revenue on the dairy farm. Thank you so much for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because at Pioneer, our name is our mission.
Precip Manufacturing, celebrating 60 years of innovation as a family-owned and operated manufacturer of grain storage, drying, and handling equipment out of Sheffield, Iowa. Learn more at precip.com.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.